Welcome to Value Investor TV podcast. My name is Beko and Hari. In episode 5, this episode, we're going to talk about fundraising to start a company. How to start a company. Yeah. In the previous episode, we talked about what is the purpose of a company, right? We talked about why do companies exist at all, right? And the reason why they exist is obviously there are other reasons than making money. Right, social goods, humanity, all those things. But first and foremost, companies and corporations exist to make money, right? And so that's what we talked about in the previous episode. And what we also talked about in the previous episode is thinking like an owner. You have to think like an owner of a business to be a good investor. So what we're going to do today, starting this episode and a few more episodes down the road, is we're actually going to start a company. We talked about this in previous episode. We're going to start a hot dog stand with you guys and bring up questions that you should be asking when you are starting a company. And first thing when you're trying to start a company is, how do you raise money? How do you start it? Like, you don't have all the money in the world to start hot dog stand. Hot dog stand, let's say, cost $10,000, right? Because you need to buy all the inventory, right? The hot dog, the buns, the water, soda, plastic bag, cart, generator. Sometimes you probably need license, right? All those things, let's say, cost $10,000. But you look at your bank account, you only have $5,000, which is this discrepancy is probably a situation where a lot of founders of a company find themselves in, right? They don't have all the money to start the next big thing or whatever. So you have to borrow money from somebody or get money from somebody. We'll talk about the differences down the road. But let's say $10,000 is what you need to start with, but you only have $5,000. So how do you fill the gap, Hari? How do you fill the gap?
Yeah, so there's, there are really two options that you kind of have, right? One is that you sell parts of the company to people that you know or to other people who have cash in exchange for a piece of the business, right? And we call that equity, right? You may be more familiar with that term from equity from the term, when you relate to as it relates to a house, right? So you pay $100,000 for a house, but you borrow $80,000, right? So you put in $20,000. Your equity is the asset, which is $100,000 minus the debt, which is $80,000, and then your equity is $20,000, right? So that ownership that you give is the equity is essentially what the owners of the business own. But the other flip side of that is debt, and so debt is something that you have to pay back on a specific time interval or on a specific time frame, right? And that debt is going to be paid out first before. So if you run out of money or your business, in this case, the hot dog stand fails, the debt holders get paid before the shareholders get paid, right? And in most cases, the shareholders will get nothing because the debt holders will get everything in that case. Right. But then the flip side of that is that the debt holders are not entitled to a share of the profits. Only the people who own the business are entitled to that, right? So, this is kind of the founder's, quandary, right? Founder's dilemma is, how do I fund my business where I own enough of it, and I can keep it, enough of it, but I can't also, the debt has to be manageable, because if I'm having to pay all of my profits back to the bank, well, then is it really even worth my effort, right? So, you have to go through this thing, and so in some cases, it's easy, if the money is small enough that you can raise it all as equity, you can go to friends and family and get that. And in some cases, it may be very large. I mean, think about, if you wanted to start an airline, you couldn't just go and ask, people for money. You'd have to get, debt. So in our hot dog stand situation, maybe your parents can loan you half of the money. But you also have to remember that banks are not going to loan you money unless you are using that money to purchase assets, right? So maybe you can get up to $2,500 because that's the cost of, the hot dog store that you're going to build. That's the cost of, the physical goods that you're going to do, because the bank can repossess those things, right? But your salaries for your employees and stuff like that, that's something that the bank won't loan you money for. So, all of these subtleties, kind of, are specific to, different situations. The bank is more interested in loaning you money for real estate or things like that, but they're not necessarily as interested in loaning you money for things that they can't recoup the costs on, right? So these are all of the, kind of the financial quandaries that you as an investor have to kind of really determine for yourself. And when you own this business, you're going to make these decisions based on what you feel is in your best interest. And sometimes it may not be in your best interest, but that's the only way that you can actually make your vision happen, right? So you got to think about that,
right?
Those questions,
right? And also, we are bringing up equity and debt, right? But there is different layers between those things as well. There's a mixture. There's a whole spectrum of financial instruments through which you can fund your company, and so we'll talk about those later in more detail. But what we want to convey to you just now is that there are largely two different ways to fund your business: debt and equity. And there's downsides and upsides on both ends, and they have very different characteristics. And we touched on that and just now. And moving forward, when you are starting a company, like Hari said, the founder's quandary about how to fund the company is something that you should be asking yourself. And also, let's just magnify this a little bit and talk about companies, right? Actual companies that exist in the marketplace, in the stock market, right? This same principle applies for big companies as well. And so this same principle, going back to think like an investor, think like an owner to be a good investor, when you ask all these questions, how should I fund this business? This is the same type of questions that you should be asking when you're analyzing a company. Right, Hari? You want to chime in on that one?
Yeah, I think we always talk about this from the perspective of, if you think about it, if you have a business that can generate money, the only thing that really takes a business, shuts a business down is when they run out of money, right? And one of the ways that you can run out of money is when you take on too much debt and you can't pay back the loan that you're, or maybe you can't even pay back the interest.
Yeah.
And so you may have to refinance the loan or restructure the loan or what. So, a great example of that is Toys R Us. This is a company that had, they sold every toy at a profit, and they made money off of almost, for decades. But really what took them out, why they had to declare bankruptcy is that the company that bought, Toys R Us from, not the original owner, but the second owner, loaded the company up with debt in order to pay for the thing. And this is called a leveraged buyout. Mm-hmm. And so when they made this purchase, they loaded up the company with debt, and then the debt load was eventually, Toys R Us wasn't able to sell as much as they had projected when the banks loaned them the money. And what ended up happening was the banks said, well, you got to pay up because you're now defaulting on your loans. And, they realized that it was actually more valuable to take out the company than it was to, try to continue to keep it running.
Right.
And so, as a holder of a company and an owner of a company, if you have too much debt on your balance sheet, right, what ends up happening is you are beholden to, other people. So we always try and look for businesses as owners. We want to look for businesses that are conservatively financed, which means their ratio of debt and equity is manageable, so that they're not spending because it's my money that but if I invest in your business, it is my money that is being spent paying down debt. Mm-hmm. And we should be very clear about this. Debt is not bad necessarily if it's under the right circumstances, but when used improperly, it can take out your entire company. And that's what we've seen with a lot of businesses, Toys R Us and, Sears and other ones.
Mm-hmm. Great. So in this episode, we talked about debt and equity. We talked about this example of starting a hot dog stand and how you would fund it. Two different ways to fund it: debt versus equity, and they're different characteristics, different pros and cons to both of them. And to the last point, if you want to be a good investor, you have to think like an investor. And all these questions that we're asking about how to finance this company through either debt or equity, those type of questions should also be asked when you're examining a company. How are they doing in terms of financing financing their business? What does their debt look like? What does their equity look like? So things like that you should always keep in mind when you are analyzing a company. And that's it for today. The topic was fundraising, how to start a company, episode number 5. We'll see you on the next episode, episode 6. See you guys. Thank you.